All right, the next article here, Brian, is the Federal Reserve cuts interest rates by 1/4 point after the election. Here's what that means for you from CNBC. Second article of the day. Federal Reserve cut its benchmark rate by 1/4% or 25 basis points at the end of its 2-day meeting. And economic anxiety was the prevailing mood heading into the U.S. presidential election. Lowering borrowing costs may offer some relief to struggling Americans.
Well, I'll tell you what it's not. It's not lowering mortgage rates.
That's true.
And, I'll remind you guys that the Fed, the president, doesn't set the mortgage rates. They can influence based on, the decisions they make, the things that they say, but they themselves don't generally, they don't at all, set the rates.
Generally? No, don't at all.
No, I'm just kidding. No, but on the contrary, you follow the 10-year, and since July all the way up into November 16th, literally the day that they announced that they were dropping rates, the market has been going up as far as rates. I mean,
yeah,
and it's rather it's rather alarming because usually you would think that rates are going to come down. But moving into the new presidency and the new year, everybody's like, yo, well, what about inflation? What about the deficit? What about spending? What about, policy? What's all these things that are going to happen that are going to either help us or not? Because they're saying, yeah, with Trump, we're going to have faster growth, but we're also going to have a lot more spending. And that's the thing that right now it's holding on the markets that is like, okay, it's good, but then we also know what comes with that, that presidency. So a lot of it is still very volatile and I think very uncertain. I mean, I've seen it in the mortgage-backed security. We're up one day, we're down the other day. It's literally up and down, up and down.
And it's been wild too.
It's been so wild, Andy, since literally September 16th. It's been up and it's been down. We've had some losses. We've had some really bad losses, followed by some good days, but we haven't been able to recover to the levels that we were in August. You know, we were touching almost the low fives into the fours at certain loans or certain credit scores, but now we're right back up to that sevens, high sevens, high sixes, which a lot of people, again, go back to the it's out of my range. Now I have to wait again until the next dip. And I think that's what's been happening throughout the year. And we've been very good at calling it out and following that, there's going to be dips in the market. We're not going to have straight drops and tanks, but there's going to be dips and times where you're going to be able to get in there, get a decent rate for the market, and then, make your way forward.
Yeah, I think there's a couple things here I wanted to mention about this. The great commentary, Brian. The first thing I wanted to make sure I mentioned to everybody is that this was already predetermined. They had already decided this. I know they're saying, they were going to announce their rate drop after a 2-day meeting. I think they kind of knew going into it. I don't think the outcome of the election, honestly, I don't even think they were expecting to have the outcome of the election known. I don't think they knew that. But I think that, again, if they're being data dependent, then the election kind of exists out here, and they're just like, okay, what do we have to make our decision on? So I really think that this 1/4% rate drop was already expected. I do think they'll probably make another one in December as well to kind of end out the year so that they can show that they're not going to be coerced by whoever the outcome and the winner was. I think they do it for that reason, and that reason in conjunction with the data dependent reasons they're talking about. Yeah. I think those things two combined make a very strong case for them to say, you know what, we're going to go ahead and do our another 1/4% rate reduction at the end of the year, like we said we would, to achieve the soft landing. Quick note here. I want to talk about the soft landing because inflation is a big problem moving forward. The spending, like you mentioned, is a big problem moving forward. The real question in the tail of the tape at the end of all this is going to be what programs get cut, how many people get cut from departments, how much money will the government save by doing that, and then what other additional revenue streams are coming into the United States to offset the additional expenses that are being proposed. Because there are additional expenses being proposed. What are they going to be offset by? I'll come back to that in a second. What I wanted to tell you, though, is that one of the things I'm looking at is that the inflation that we are being told is falling back or going down is just slowing. I want you to remind that. I want you to remember that. I want to remind you that this is like flying on an airplane at 20,000 feet, and then it goes from 20,000 feet to 30,000 feet really quickly, and then it goes from 30,000 to 33,000, then to 35,000, then to 36,500, then 37,000. It made a really big ramp up, and I think what we're having here is normalization of pricing. Yeah, and that's my point. I want to make sure that I'm saying this on the record, and I can eat my words later in the rearview mirror, coming back to this however long from now, and I can be wrong, and that's fine. I would love to be wrong. But I think that what happened is in the last 4 years, we had such a rampant increase of prices across the board, and now this slow tippy-toeing our way, continuing on that direction, this is on top of that massive height increase we already had.
Oh, yeah, milk, $6.50 a gallon? Yeah, that's fine.
Well, it's not $6.50 everywhere, apparently. We just live in stupid California.
No, I know. Oh, organic milk? Yeah.
Yeah.
$7.99.
Now, here's the thing. I wanted to remind everybody, if you don't know how long it took us to get here, it took us 2.5 years to get here. Okay. It's going to take us that long or longer to get out of all this if we get out of all this. The price normalization is for a reason, and they're using language to tell you that that's what they think is happening, and I'm going to tell you about that in just a second, because I think I wrote it down here somewhere. I don't know where I put it here in my notes, Brian, but I was like, oh, this is a signal that they are, because getting inflation down and getting rates normalized is going to help getting the housing cycle normalized. So as it relates to housing and as it relates to money, if they're talking about getting it normalized, that means that they want us to start expecting this as the new normal.
Yeah,
Here we go.
It's slowly ways of conditioning people to say, hey, well, this is the new norm. Hey, this is what we got to get used to. We've already been through it for 2 years. Okay, it's okay. Yep. It's fine. We'll figure it out. And unfortunately, some people, they have no choice but to figure it out. And you have to keep moving forward. Life's going to keep going on. Like, they're not going to drop prices for anybody. And as you see, it's going to take a lot faster to get down than it is.
So Fed rate cuts are going to help us in a couple of different ways. I am concerned that it's going to lock in the inflationary prices that we're at now, the elevated prices. You have credit cards here. Trump announced a 10% cap on consumer credit, which is essentially a flat rate.
So I want to...
But that has to be enacted. That has to be enforced. Yeah. The companies have to... I mean, that... Like, again, that's one of those things. You can lob that out, but like making that happen, that's a lot of work that needs to get us there.
Oh, 100%. But to that point, I just had a conversation literally before this podcast, and one of the things that the rate cuts will help regular Americans is with their credit card interest rates. With what they're paying on interest. I had a call today, and one of my clients was like, "Hey, I want to sell my house. Over the last 3 years that I've owned the property, I have racked up a few debt." And he's like, "It's not that I can't pay it off. It's just the interest is killing me." Like, he literally said that. He's like, "The interest is whipping my butt." He's like, and I literally want to just get off. I just got a job raise. I just want to, sell my house. I want to move into a different place. I now have a higher net worth. I got a few raises along the way. So he's like, the interest rate's killing me, dude.
Wow.
And another conversation I had with another client was between a HELOC or a HELOC or a cash out refinance. They wanted to do a cash out refinance. They wanted to do a HELOC, even though their payment was only going to go up $400. Their payment was going to go above $5,000. Their current payment was $4,600. We looked at the cash out refinance, and their payment only goes up $400.
Oh, wow.
But you're paying either a 5.75 rate on a cash out refinance, right, or a 10 to 11, 13% on a HELOC. What I told my clients, and they asked me, they're like, well, what do you suggest? Well, I'm like, down the line, either way, you're going to have to pay the HELOC by refinancing it into the loan or paying it all lump sum and, not using it anymore. My advice is, you're paying more interest on your debt if you're going to consolidate everything in the HELOC because your rate is 10%. So what's more important, the rate or the monthly payment? They're like, well, the monthly payment, because I'll be able to have more cash flow and I can afford it. I'm like, well, then the cash out refinance is going to help you. You'll get a lot more tax write-offs, benefits as well for you doing the refinance this year. And then down the line, we could do a rate and term and then bring the rate back down. And then we don't have to do anything else after that. This would be like a temporary Band-Aid. Mm-hmm. But she wanted the two options between the HELOC and the home equity line of credit. Wow. But in this instance, even though it's only $65,000, $50,000 that they're taking out, it makes more sense to just put it into the property, pay off all your debt at a lower rate, and then
right, because their out-of-pocket expenses are dramatically decreasing month over month.
Yeah, exactly.
Wow, that's crazy. Again, it's not crazy. Yes, I'm saying crazy because no matter how many times you guys tell me these stories, they're still happening, and we've been talking about this all year long. And people are going to use their house as kind of like their get out of jail free card financially, and they keep doing it. And people are just in this situation, and I totally understand that. I understand that making ends meet and doing the things you need to do and letting the house pull some heavy weight. I 100% understand that. We need to go ahead.
The crazy part is that combined income, they're bringing in like $220,000 a year.
Yeah, that's wow.
Just to let you guys know and give you guys some perspective, you could be making good amount, six figures, and you could still be hurting. Just because you make a lot of money doesn't mean you don't pay a lot of money every month. Mm-hmm. It's everybody's. I still truly believe that everyone's struggling in their own battles in their own way. No matter how rich you are, how successful, how big you are, there is issues in every aspect in everybody's life. Nothing's perfect, so just Just know that everybody's silently hurting somewhere or another.
Size of life and size of spending.
Yeah, 100%.
So decreased Fed rates are going to help in other areas. To round this out, Brian, we're going to have reduced auto loans, mortgage rates, maybe, but that's just more as kind of like a secondary effect of general economic stuff happening with the bond market. Go ahead.
No, it's just, I think it's so crazy how we don't look at the perspectives of how, you know, a car loan, a credit card, a personal loan are so high in interest, yet we're willing to utilize those types of financial ways out rather than utilizing one that, you know, is the most secure thing that you're going to for sure always pay, that you live in, that you utilize day in, day out. I mean, you can't live in your credit card. You can't live in your personal loan. And you could definitely, I mean, you can't live in your car, but come on now.
Your credit card doesn't give you a lot of shelter when it's raining.
You know what I mean? So it's like, I understand the logic between that. Okay, I don't want to, because I'm never going to pay my house off. But then again, like, well, are you ever going to pay your debt off if you're always using it over and over again?
Yeah, it's just recycling it.
Exactly. It's a revolving debt.
Well, yeah, there's other parts of the economy and your personal spending that are going to benefit from the Fed decrease. I do expect there will be another one in December, and then we'll have to see what quarter one of 2025 looks like. I really, really want to know. I cannot wait. This is so nerdy. I hate this. I cannot wait for getting into January, February 25 so we can look back at fourth quarter of 2024.
Yeah.
I think so much stuff is still yet to change, even though we only have like 6 or 7 weeks left in the year. That sounds like a very short amount of time. That's a lot of time for stuff to change, especially also coming into what we call spending season. So
that's what I'm kind of like, yo, like it's going to be interesting, those numbers again.
Yeah.
And remember last year we broke records because everything was just more expensive.
Everything's more expensive. The spending was all-time high. Yeah, it's crazy. Spending all-time high and personal debt's all-time high. Credit card rates, credit card balances. Good times ahead.
America's that meme right now with the fire dog. Yeah, this is fine.
The dumpster
we're
behind
okay.
him. Everything's fine.
Everything's good.